For August 24th. I'm your host, David Michalek, and with me is America's #1 credit expert, John Ulzheimer, formerly of FICO and Equifax. John, again, thank you so much for being here. This is 2 times in a row. This is back to back.
That's right, back to back. We're on a streak.
Well, next week I'm going to be gone. My business partner Dave and I are going to be heading off to Miami for a seminar there. So there will not be a Facebook Live Wednesday. So I'm very appreciative that you're able to join me back to back so we can get our two in a month here. Okay, yep. So you know what? Let's do this. I see we've got some people jumping on. I know we talked about a couple of subjects today, but I wanted to call an audible. What do you think about? I was fascinated with the subject that you sent over earlier today about discussing like the full ramifications of bankruptcy.
Yeah.
And when I saw that, like later on in the day, I'm like, that's a really good topic. Not just because it's great to know, and I'm not saying obviously applies to everybody or even a large portion of the people on here, but I think as we swing back through, as the economy cycles, when I got into this business, it was bankruptcy, it was foreclosure, it was short sale back in 2009, 10, 11. So just to talk about what bankruptcy does to credit and credit reports and scores and what that does. I think it's a good topic to discuss now, considering that things are looking a little dodgy with the economy, and I think we both know that this is going to be something that's going to be just around the corner for, unfortunately, a swath of the population.
Yeah, so the last time I did any research on the volume of bankruptcies, I think it was like somewhere around 1.6 million filings per year. I don't know if that's still accurate or if it's gone up materially or if it's gone down in any material fashion. Let's talk about and there's really three prongs to this. There's the public record, there's the actual filing, and then there's the discharging of the debts, and then there's kind of the aftermath. And the aftermath, you could break it up into like 5 different subcategories. And so we're not going to, we would go the entire 45 minutes if we walked through this. So generally speaking, there are 2 types of bankruptcies that consumers file. That doesn't mean that there are only 2 types of bankruptcies that can appear on a credit report. In fact, I don't know if you remember, David, but I was in Los Angeles for 9 days back in March and April. And the trial, one of the issues in the trial was that this guy ended up with a Chapter 11 bankruptcy on his on his personal credit report. So we know that while Chapter 7s and Chapter 13s are the commonly filed consumer bankruptcies, that doesn't mean that other types of bankruptcies that doesn't mean that they can't appear on credit reports, because there's a jury verdict for $2.9 million that says otherwise. So when a consumer goes to file bankruptcy, they don't know what chapter bankruptcy they're going to file. The bankruptcy attorney, using a means test that's set in the bankruptcy laws, that will determine what chapter the consumer qualifies for as far as their bankruptcy. And that's based on your income. So depending on how much money you make, you may qualify for a Chapter 7 bankruptcy if you make too much money. And when I say too much, I don't mean a large amount. I'm just saying more than, I don't know if it's the state mean or I don't know what the metric is, but it's not that much. But if you make more than whatever that baseline is, then you're essentially required to file a Chapter 13. So a Chapter 7 is commonly referred to as a straight bankruptcy. And I don't know that that's a formal term. I just hear people calling it a straight bankruptcy. And with a 7, any debt that is statutorily dischargeable, meaning that it's legal to discharge the debt, is automatically discharged in the bankruptcy or automatically associated with the bankruptcy. So that would be things like your credit card debt, your mortgage, your auto loan, things like that. So some debts are not statutorily dischargeable. Normally, student loans are not, tax liens are not, family and child support is not. Right. So there's certain types of debt that you can get rid of, and there's certain types of debt that you can't get rid of. And when you file for the bankruptcy, if you do qualify for a Chapter 7, then all of those debts are essentially going to go away. So you're not going to owe that money any longer. Now, the precision in the language is important here, because a lot of people talk about how, oh, my account was included in the bankruptcy, and I don't owe that lender any more money. Those are common ways of describing, and while it's, for informal discussions, those terms are probably fine. But if you want to make sure that the precision occurs and it's not actually what happens. So in other words, accounts are not discharged in bankruptcy. So if you had an account with Chase for a credit card, the bankruptcy doesn't make the account somehow disappear as if you never had a relationship with Chase.
Right.
And the debt that's associated with your account, that also doesn't magically disappear. Chase still believes that there's an X $1,000 debt sitting out there that they're owed. It's just that they can't come after you to collect it. So essentially, it's legal protection from your creditors. It doesn't extinguish your account, and it doesn't really get rid of the debt, because I can assure you the creditor still takes it in the shorts with a Chapter 7. They just can't come and collect it from you. So really, the proper way to say it is that the debt has been discharged in bankruptcy, which means that the lender can't attempt to collect it from you any longer. If there is a co-borrower, so if you have like a joint credit card, they can absolutely go after the co-borrower. And your bankruptcy does not protect the co-borrower unless both of you have filed for bankruptcy. In a Chapter 13, more commonly referred to as a WEP or a wage earner plan, you're essentially paying an amount every month to a trustee, a bankruptcy trustee, and the trustee is distributing those funds amongst your creditors. It's considerably less than what you actually owe them, and after a period of several years, then those debts are going to be discharged. So you're essentially going to pay much less than you actually owe, but you're still going to pay something, but it's not going to be everything. And so in most Chapter 7 or Chapter 13s, discharged within 3 to 5 years-ish, give or take. And then once you're done paying through that, then you don't owe those debts any longer. So that's kind of what occurs practically. I mean, there's a boatload of paperwork that occurs. So I'm just kind of giving you the highlights of what happens when you file for bankruptcy protection. You also have to go through mandatory credit counseling as part of the bankruptcy filing process. That's a requirement.
Has that always been a thing? Because
no, it hasn't.
Is that in the last 10 years or so? Or
yeah, and I don't remember when the bankruptcy law was amended to include this whole Chapter 7 versus 13 thing, the test about the income. But that's when the provision about mandatory credit counseling was when it became a thing. So it wasn't always there.
Yeah, I think that right after the whole 2008, 2009, Great Recession, where it was just bankruptcy after bankruptcy. I mean, I knew some bankruptcy attorneys in San Diego, where I used to live, that were just, they were filing bankruptcy for their clients left and right. These are guys that are working 7 days a week, and so they're discharging debt and they're driving around in their Ferraris at the same time. So
they're killing it.
There was I think that at some point, whoever makes those decisions said, you know what, we're not going to make this as easy as it used to be. And if you're going to go through this process of discharging debt, whether that's, like you said, a straight bankruptcy, or it's going to be the wage earner plan, you're going to have to go through some kind of credit coaching, so you don't go through this process again. Or even if it's just for show, maybe it's just to make it a little bit more inconvenient for people. Who knows? Let's real quickly take a couple of questions before we fall behind. So Mike, question: instead of points dropping when you use any of your credit and you don't pay it off in a month, why not have it drop when you miss payments instead? All right, hold on.
You're questioning why FICO chooses to cause your scores to be different. I think you're trying to apply common sense and kind of what makes sense to you to systems that are completely empirically derived, and they don't care about, why don't we do this when this occurs? So your score, first off, and your scores don't drop, right? It's not like a thermometer where it got colder and the temperature gauge just went down. Your score is just different than it was the last time it was calculated. And if it's lower, then a lot of people say, well, my score dropped, when really that's not really what happened. But whether or not you make your payments on time, and all of the other metrics that have anything to do with payment history, that's like a third of the points in your score, which my father and I always argue about this. He kind of has your perspective. He thinks that if you make your payments on time, you should have a perfect credit score. And so he doesn't understand that 2/3 of the points in your score have absolutely nothing to do with whether or not you make your payments. And so sure, your scores can be lower for a whole lot more reasons than missing payments. And so, but I mean, I get it. I understand it's not just missing payments that makes someone risky. That would suggest that someone who has a perfect payment history, they all have 850s, and that's obviously simply not the case.
So Gregory had a statement here. I think it's because of your debt ceiling. Once you go over 30%, the probability of you paying over 40% is harder. I think we're talking about maybe chapter 13, how they're trying to structure.
No, I think he's answering Mike's question.
Oh, gotcha. I see. Yeah. I see.
Yeah. So again, you're trying to ascribe an answer to a question that doesn't have an answer, right? So why is it that higher utilization usually leads to low scores, and low utilization leads to high scores? And then people all of a sudden try to hop in there and, it's because you're going to have your minimum payment's higher, so you're going to have a harder time. That's not why. It doesn't have anything to do with that. The answer to every single question about why does this count in my score and why is my score lower than it was last month is because something changed on your credit report, or something is on your credit report that is indicative of elevated risk. That's it. The reason that your score is lower because of high utilization is because high utilization is indicative of elevated credit risk, and you earn fewer points in that category. You can try to explain it, but that's not the reason. The reason is because there's an empirical relationship with that ratio going up and your risk going up, and therefore the points you earn for that category are going to go down. So that you can say the same thing about why do more inquiries cause a lower score? Why does a 90-day delinquency cause your score to go down more than a 30-day delinquency? But the answer to every single one of those questions, and every other future question about why does my score react a certain way when changes on my credit report occur, is because there's an empirical relationship between that activity and risk. And it is, it materializes in the form of either a high credit score, a modest credit score, or a low credit score. I'll give you a great one. Here's one that is not explainable. Why is it that having a bad credit report usually leads to a lower insurance credit score and therefore higher insurance premiums? What is the correlation between poor credit and insurance risk and therefore premiums? And I'm going to get a million answers in the comment section from you. Probably didn't listen to the answer to my question. The answer to the question is because poor credit, there's a relationship between poor credit and insurance risk. It's empirical. That's the only reason insurance companies are able to use them when setting premiums. There has to be a relationship between the two. You can't just say, well, I think it's because people are going to file more claims if they have bad credit. That may be true, but that's not why your credit report is valuable to insurance companies. There have been studies done out the wazoo by the insurance industry and insurance companies in particular that prove repeatedly, despite how many crybabies want to say that there is no relationship, there is not only a relationship, but it is a solid as a rock relationship between the quality of your credit report and what type of an insurance customer you're going to be. And so that's why, and trust me, politicians hate it. They hate the fact that credit reports are used for insurance. They hate the fact that credit reports are used for employment. They kind of hate that credit reports are used for credit, to be quite honest with you. Next time we're coming, if we have the same discussion next year at this time, we're probably going to be talking about how bankruptcies can't be on credit reports any longer and late payments can only stay for 6 weeks. And, it's kind of a diluting of the information. So, but that's the answer to all of it, is because, well, why does this happen when that happens, is because, well, there's a mathematical relationship between the two
Well,
things.
even on a more like smaller and granular level, John, one of the things that, like, I remember my stepmother having this conversation with me about, and she was one of I think 3 background investigators for the San Diego Police Department, and that's where she spent the last several years before she retired. And one of the things that they looked at heavily for candidates coming through the police force is, what kind of credit do you have? Are you high risk? Do you have high debt? And that they looked at that as, just like the insurance company looks at people with bad credit, is like, are you susceptible to things that we wouldn't want you to be susceptible to
Yep.
as a peace officer if you have high debt? It's the same thing that going into security or going into sensitive areas of the government where that might be an area of compromise. So it's all along the same lines.
Yeah, try getting a job with the TSA with any defaulted debt, and try getting a security clearance with bad
Right.
credit.
Right.
It's not going to happen.
Yeah.
And that's that's kind of the position that they take, is that we don't want someone who's manning a TSA station to be getting hammered with phone calls from debt collectors when they should be focusing on their job. And number 2, we don't want someone to be open to or considering the possibility of someone bribing you with money to get yourself out of debt in exchange for you doing something for me that may put someone else's life at danger. And so that's the whole issue with respect to security clearance, and then jobs like the what I call kind of the point of vulnerability jobs, like what you have with TSA.
Yeah, exactly. All right, just a couple more things here. We'll get right back on the bankruptcy talk. Duke's got a question. Can you talk more about the 1% rule? Didn't know it was a rule, John.
Yeah, so I think you're referring to the utilization.
Yeah, I put the second one up just so he can clarify a little more. Yeah.
Thank you, Duke. Yeah, so it's not really a rule. It's not a credit repair strategy. It's not something that some dude on YouTube discovered. FICO has been talking about this for almost 30 years. So what I think we all know that utilization, the formal term for this is not utilization, it's revolving utilization. People call it credit utilization. People call it just utilization. Some people call it the balance to limit ratio. That's pretty good. But it's really revolving utilization. And revolving utilization is the relationship between your credit card accounts, the balances of your credit card accounts, and the limits of your credit card accounts expressed as a percentage. And the higher that ratio, the more likely you are to miss payments, and therefore that's why you don't earn as many points in that category. So there's a ton of garbage floating around on the internet about this ratio. Number one, a lot of people think that it includes loans. It doesn't. That's why I always get very particular about calling it the revolving, and that's what we called it at FICO. It's not like John Ulzheimer made up a name and that's what I call it. That's what we called it whenever we talked about it when I was presenting this on behalf of FICO, the company that invented it. So it doesn't include loans because loans aren't revolving, loans are installment. Number 2 is it really only includes plastic. So credit cards, retail store cards, petroleum cards, those are the cards that are part of this revolving utilization metric. For some reason, people tend to believe that HELOCs are considered in this ratio, and they're not. Even though HELOCs are revolving, HELOCs aren't credit cards, so it's just credit cards. In the more contemporary versions of FICO's scores, even charge cards are not included in the ratio because charge cards aren't revolving. They have it's called open terms, meaning you have to pay in full every month like you do your utilities. So it really only is your revolving plastic, your credit card accounts. So we know that ratio can be anywhere from 0 to some value greater than 100. And the higher that ratio, the more risk you pose to a lender and the fewer points you're going to earn. And that ratio is very important. So what's the target ratio? So VantageScore has gone on record ad nauseum saying that in our scoring systems, the target ratio is anything below 30%. All right. FICO does not provide a target ratio. They don't say if you keep it at 20%, you'll be fine. If you keep it at 50%, they don't do that. Instead, what FICO does is they publish metrics of people, kind of the common habits of people who have really high scores. And for people who have very high scores, and when I say really high scores, I'm talking like 780 and above, like elite level credit scores. Those people have an average revolving utilization of, drum roll, 7%, right? So whenever I talk about the target ratio, I always say less than 10%, because then you're golden in the VantageScore systems and you're also golden in the FICO systems. So what Greg, I think, was it Greg that asked about the 1%? I lost the
Duke.
Duke, I'm sorry, Duke. Give credit where credit's due. So Duke asked that question. So FICO has, and we used to present this. So it's not zero, and anything above zero, you start losing points. Believe it or not, you can actually do better at 1% utilization than you will at 0% utilization, and anything above 1% is where you start foregoing points. And there's no logical explanation for this other than people who have 1% utilization are a slightly better credit risk than people who have 0% utilization. Now, I want to make a couple of points here. I'm not talking about the difference between good and bad. I'm talking about the difference between awesome and mega awesome, right?
Yeah.
So if you're at 0, please don't sit there and freak out that you just heard that 1% is better. You're fine, okay? And you should target 0%. But it is a fact that if you can somehow figure out a way to have 1% utilization in that revolving utilization metric, then you're actually, for that particular scoring session, going to do better than if you had 0%. So now here's my challenge to everyone who's watching us. Remember, this ratio is based on the information on your credit reports at any point in time, in any particular snapshot in time. It's not what your balances are on your credit cards today as we're speaking at 6:22 Eastern time on Wednesday. It's not what your credit card balances are going to be tonight at midnight. It's what's appearing on your credit report. And what's appearing on your credit report is between 1 and 30 days old. It's not real-time information. So in order for you to try to get a 1% ratio, you would have to figure out what your credit limits are, remember, just on your plastic, and then figure out what 1% of that amount is, and then figure out some way to get that amount to show up on your credit report as a balance.
Yeah.
At the same time that some company is pulling your credit report to score it. So I guess good luck with that, because first off, let's say you have $40,000 in credit card limits, and all of them are 0. You have no balances on any of them, because in order to do this, you have to kind of start from 0 and go up to 1. It's going to be real hard to pay everything down to equate to 1%. But 1% of 40,000 is $400. So you're going to have to figure out how to cause $400 in balances to appear across all of your credit cards at the same time, on the same date that you apply for credit somewhere. So yes, the 1% ratio is a real thing. It's not a trade secret. FICO's not going to come sue me because I'm talking about it. It's out there and well published. It's not something that some credit repair dude says he discovered through research. That's bullshit. FICO's been talking about it for 3 decades. But my point is that it's a whole lot easier just to shoot for a low ratio and be happy with it than try to nail that 1% for any extended period of time.
Yeah, and also too, and you did touch on this, but I really wanted to emphasize it. And I'm not saying, Duke, this is the case with you, but just me being in the part of this industry that I've been in for the last decade, it's really important to emphasize that this 1% is not going to take that person from a 550 to a 650. I mean, this is, as John said, this is going from elite to super elite. Yeah. In fact, John, the only 850 that I've ever seen in my life was achieved purely by accident, and it was your score that you showed us at a summit about 4 or 5 years ago, and you put a screenshot up on the screen. You said, listen, this was a total accident because I pay everything off, and it just so happens that my wife had a balance. She charged something that wasn't, it wasn't paid in full at the time of the reporting, and because of that, you got that 1%, and you made a
Yep.
pretty good case about it, as pretty much explaining what you've explained now. But what did that actually mean for you? Okay, so what did you do? Go from like an 842 to an 850? I mean, we're really talking about a sliver of progress, right?
Yeah, look, it's not even. I wouldn't even call it progress. If most of the
Well,
people
okay,
who are
incremental, a sliver of incremental increase, then maybe
so
not progress, because you're already in an elite level.
most of the people who are trying to repair their credit are trying to. Their credit is bad because of negative information, right?
Yeah.
I mean, are people? I don't know, David. You tell me. You're the credit repair expert. I mean, are people filing disputes about the balances of their credit cards? I've never seen a dispute letter that is challenging a bunch of balances on credit cards. It's usually, this late payment is is not real, or
Yeah.
this collection doesn't belong to me. It's usually that kind of stuff.
Yeah, the only time you see that is like, hey, well, no, actually, not even really the balance. That's not right. You're right. That's not going to be a core dispute that people are trying to challenge. It's
Yeah.
things completely different than that. That's
I
mostly just
kinda,
like a how do I improve my credit tactic that a lot of people are
yeah.
read somewhere and like,
Like,
okay, I got to get to 1%.
I like how Duke thinks. If there's a point out there, it's almost like in Super Mario Brothers. I want to get all the little gold coins, right? And
Yeah,
so
right.
to the extent that there's a point out there that's available, then we should learn about it and we should talk about it. And if it's something that someone wants to go after, then fine. But I'm just telling you that generally speaking, you're going to do fine if you can keep your utilization to around 7%. That's a whole lot easier to do. It's actually a whole lot easier to do if you have what I call credit utilization insurance. And it's not an actual insurance policy that you can buy, but you can actually almost ensure that your ratio is never going to spike above 7 or 10% by having a ton of credit cards, most of them that you don't use except from time to time just to make sure the card issuer doesn't close them or lower the limits. I'm not going to tell you the exact figure because it's, I tend to not tell that stuff. But let's just say hypothetically that I have a dozen credit cards with over $200,000 of credit limits. Let's just say hypothetically that I have acquired that over the period of many, many years. Well, 10% of 200,000 is 20,000. I don't know a lot of people who have an average balance of 20,000 every single month on their credit cards. So even in the months where I may put a ton of stuff on my credit cards, it's highly unlikely I'm ever going to get above 10%. And it's actually going to be a whole hell of a lot easier to keep it down around 2 or 3%, because if you look at that relative to a ton of credit limits, it acts as credit score insurance to me. So I like that as a strategy. Now, look, the personal finance, kind of the pretend personal finance experts who sell a bunch of books at churches, they're going to say that credit cards are evil and you shouldn't have any credit cards, and your credit cards, act as an incentive to get into debt, whatever. If it sells books, then good for those people. I like having a ton of credit cards, not because I want to get into a lot of debt, but because I like having them out there as utilization insurance. Because if there is a month where, man, I got to put $3,000, so I got to buy a new refrigerator, I got to buy new tires, and I've got to buy clothes for my son for school, and all that stuff kind of happens at the same time. And boy, I really want to take a vacation next month. And let's just say hypothetically that life happens and I end up with $10,000 or $15,000 in charges. I'm still not even close to 10%. And so if you look at kind of the natural, we talked about this last week, David, the natural score migration, for some consumers, if they only had $20,000 of credit limits, their score just went like that.
Yeah.
Because they just spiked their utilization spiked. For someone who has a ton of limits available, they're kind of rolling within that tight band of the 20 some odd points that we talked about. So that's why I like that. That's why I like having a boatload of limits, not because I want to go flex, because it's insurance for me.
Yeah. No, that's a really good point. Scott, second part of his statement here said, I hear you, John, on it being more than paying bills on time that affects your score. What would you say is the most important or most impactful factor?
Well, if you broke it down into the relative value of categories of metrics. And again, FICO has been publishing the pie chart for 3 decades. I love how people call it a black box. I'm like, really? Have you done any research at all? Have you spent 10 seconds on Google? Because they give away a boatload of information about their scoring systems, this supposed black box. And if you knew where to look, you can actually find almost an entire list of their characteristics, which is pretty, behind the curtain type of stuff. But look, they're very open and transparent about the payment history metrics, and to me, that's kind of a complicated way of saying the presence or lack of bad stuff. So if you have only good stuff on your credit report, then you're essentially banking a little over 1/3 of the points out of that pie chart. And almost equal slice of pie is the debt-related metrics. A lot of people incorrectly believe that revolving utilization ratio that we just talked about is worth 30%. That's incorrect. It is part of the category that is worth 30%. Don't believe me. Go to FICO's website. It's right there listed. There's like 5 or 6 other metrics in the debt category, and collectively, they're worth 30%. So between the presence or lack of bad stuff and how well you manage your debt, that's 2/3 of the points in your score. So you're going to go a long way to banking a really good score if you just avoid negative information and keep your credit card debt, to a modest amount. It's not that hard. You can have a ton of installment debt, and I'm talking hundreds of thousands of dollars of installment debt, and still have elite level credit scores. It's the revolving debt that's the problem, because it's usually unsecured, it's a higher risk, it defaults at a higher rate, and therefore it's more correlated to elevated risk. Therefore, you don't earn as many points for having that kind of debt. So that's what I always tell people. And people are like, wow, I didn't really need you to tell me then. You're basically saying pay your bills on time and stay out of debt, and that's how I'm going to have a good credit score. I'm like, yeah, you didn't really need to have a credit expert tell you that, but for some odd reason, I've made a 31-year career out of this, because people tend to get confused and lose focus.
Yeah, well, that's a big problem, as we've discussed many times, that nobody pulls us aside in high school or college and gives us at least the very basics on how this stuff works. Agreed. But now we're fortunate that a lot of this stuff is readily available online. Gregory makes a good point to what we were talking about a second ago. High limits give you breathing space. Went from 1,500 to 15,000 credit limit using credit Versio and other tactics to raise my credit score and limit. Great job, Gregory.
So can I use his, Dave, do you mind throwing that back up there? Let me use Greg's example, because I think it's a fantastic example. So Greg went from a $1,500 limit to a $15,000 limit. Let's say hypothetically, Greg, I come to town and Greg takes me out to dinner and we go clubbing, and Greg picks up everything. And so after our night of fun, Greg has just run up a $1,500 balance. In the old iteration of Greg, he is 100% utilized on that credit card. In the new iteration of Greg, he is 10% utilized on that credit card. He has the same amount of debt, $1,500, nothing's different, but the ratio is materially different. And if that was his only credit card and he was 10% utilized versus 100% utilized, obviously that's a meaningful difference in credit score. So that's the importance of having high limits on credit cards and having credit cards with unused, where the limit is completely unused. You just kind of have it for the sake of having it. That's the real practical value.
Okay, so we got two. I'm going to go bottom to top. What's this? Len Jones. Are goodwill adjustment letters legal for creditors to not report information on a consumer's credit bureau?
So I think Len's new. Is Len Jonas new?
I think so. Yep.
All right. Well, welcome, and thank you for spending a little bit of your Wednesday evening with us. So let's talk about goodwill adjustment letters. What do they say? Everything after or everything before the word "but" didn't count, right? So let me put it in that kind of in that format for you. I talked to my creditor or my debt collector, and they sent me a goodwill letter, and that letter said they would delete it, blah, blah, blah. But the credit bureau said that they wouldn't honor that. So basically, everything before the word "but" didn't count, right?
Mm-hmm.
So I can tell you, Len, that in the it's almost there's a difference between what is recognized as a matter of policy versus what actually happens. And what's recognized as a matter of policy in the credit reporting world is that there is no such thing as a goodwill adjustment. It doesn't exist. In the 350 pages of the credit reporting standards manual, I promise you, sir, that you're not going to find anything in there at all about pay for delete letters. I think, is it called a goodwill? Some people call it goodwill deletion.
Well, it's a goodwill letter. It's often what's referred to as, that's something you send to your creditor. Hey, I used to be a good borrower. I went through a tough time. Here's what happened. I'm good now. As a courtesy, can you go back and, correct the late payment history? It's referred to oftentimes as a goodwill letter. Yeah.
So and you're essentially asking them to do a goodwill adjustment of their credit reporting is what you're asking them to do. So it's either in the form of a goodwill deletion or a to kind of reconsider something like a late fee or whatnot. In the entirety of credit reporting, the formal side of it, there is no such thing. It doesn't exist. So if you send, and by the way, neither David or I are lawyers, and so we can't interpret what's legal and what's not legal because that's beyond what we are. Well, I can speak for me. That's beyond what I'm qualified to do. I can't tell you what's legal and what is not legal in that respect. Now, if you have a contract with some company and the contract binds them to do something and they breach their side of the contract, then obviously you may have a breach of contract claim against them. But from a credit reporting perspective, there is nothing that the credit bureaus publish where they indicate to any of the 14,000 companies that furnish information to them on a monthly basis that they will honor any such goodwill requests on behalf of consumers. So does it happen? I'm quite certain it does. Is it a formalized process? It is not.
Jay's got a question here. How long does it take to recover, points-wise, from opening two accounts at the same time?
Your score may have gone up because of what you just did. If you just went from a very high utilization ratio to a low utilization ratio because you just opened two new credit cards, then you don't want your score to adjust. You like it where it is. But of course, obviously, when you open two new accounts, it's at least two inquiries on one or more of your credit reports. And then the bigger deal is now you have brand new accounts on all of your credit reports, and that's going to reduce the average age of what's called average age of trade. It's going to reduce the average age of trade on your credit reports, and that can, in fact, cause your score to go down. But the net of what you've just done may actually yield a higher score, not necessarily a lower score. If the inquiries are problematic, then 12 months, they remain for 24, but they're considered in scoring systems for 12. And if they're lowering your score, then they're going to lower your score for the full 12. That's another one of the interesting myths about inquiries. That is, if you have an inquiry that somehow it loses value over time, that's not true. Inquiries, if it's less than 12 months old and it counts, then it counts. It's not like a late payment where as it ages, it reduces the impact, or the impact of it reduces. With inquiries, it's binary. Does it count? Yes. Does it count? No. And that's it. How long is it going to take for your score to recover from the reduction of the average age of trade? It might be years. If you just went from having a 20-year-old credit report to, this is going to be very scenario based. Okay. So for someone who's had 3 decades of credit and you add 2 new accounts to it, the effect may be nothing. It's almost like, how do you change your GPA in your very last year of school? It's really hard because you have like years and years of classes and it's hard to change the average. However, if you have, 1 account on your credit report and that 1 account is 10 years old and you just added 2 brand new accounts, then you've just reduced your average age of trade down to whatever, instead of 10 years to whatever 10 years divided by 3 is. And so essentially 3.3 years. So that's a big deal. And it's going to take you a long time to get back to 10 years on average. So it's very scenario based. And obviously the answer isn't going to be the same for everybody. Look, don't avoid applying for credit because of shit like this, right? Avoid applying for credit because you don't need it. That's why you avoid applying for credit. If you find a credit card that you want and you need it, apply for it. If you find a car that you like and you need a car and the rate is good and you like the deal you're getting, buy the car. And I'm not saying this is what you're suggesting, Rodriguez. I'm just saying that it's almost like sometimes I have to talk people into enacting in commerce because they get so almost terrified of, oh my God, what's this going to do to my credit score? And I keep telling them, who cares? You need a car, dude. Go buy a car. You got to get to work, right? You got to drive around. Just don't open up 12 retail store cards for Christmas. I'll tell people not to do that. But otherwise, I'm like, bro, look, we're talking about inquiries, and it's like the lowest thing on the list, and the average age of trade, it's the lowest thing on, right down there with inquiries. So to the extent you get into new debt, then fine, just pay it on time. And as your credit reports continue to age, then you're going to kind of earn those points back organically, and you're going to be fine. We shouldn't just go into paralysis because we're afraid of what it's going to do to our 850.
Yeah, it happens a lot too, especially on this side of the industry, John, where you got people, and I was like this too for a short period of time, where you go through a devastating event, you're trying to rebuild, everything becomes hyper amplified because it's like, okay, now if I do this,
I get it.
My score going to do because I spent 5 years, 4 years, 3 years, whatever, how many years with a really bad credit, which is a very personal, very emotional thing. So, but you make a great point. Like, you got to get stuff, and it's all going to sort itself. Right. It's all going to sort itself out over time.
I remember the guy, and one of the things that drives me crazy more than anything is people taking credit for things that I've written or plagiarize. Is one of my biggest pet peeves. So I try not to do it. So the guy who hired me at FICO, his name is Tom Quinn. He's still there, actually. He's been there for like 700 years. And so Tom we used to talk about this whenever we were, because when I started at FICO, it was right when Fannie and Freddie mandated the use of FICO scoring for mortgage lending. And so it was brand new in the mortgage industry. No one knew what it was. No one understood it. No one liked it, of course. And of course, who got to fly around the country making presentations at the Mortgage Broker Association and Mortgage Banker Association meeting? Well, the low man on the totem pole, which was me. So I was always the least popular guy in the room when I got up there and talking about how FICO this and FICO that and payment history this and this is how it works, blah, blah, blah. And Tom and I used to always kind of laugh about how, I don't understand why people are so upset about this. If it's like losing weight. Stop eating so much pizza and run more. You're going to lose weight. It's like a biological certainty. It's the same thing. It's the same thing with credit scores. Pay your bills on time. Stay out of credit card debt. Don't apply for credit excessively. If you do those things, it's almost impossible to not have a fantastic score. But you're right. People tend to get kind of hyper focused on the kind of the tricks, and it's almost like they'd rather fool the system than to kind of operate within the system to a point where they're going to earn credit scores that are really good because they're a good credit risk, and then they never have to worry about these types of things.
Yeah. Let's see. Oh, you know what? Duke's got a good question.
Bring it.
Will VantageScore 4.0 start to replace 3.0 over the next couple of years?
That's a good question. 4.0 has been around for a while.
I don't know where John, I don't even know where I've seen it before. So I look at all the, the sources that we partner with, everything is 3.0 still.
That's right. And, VantageScore is very commonly used in the direct-to-consumer world. And so if you're looking at a credit report that's a direct-to-consumer credit report and it includes a score, chances are it's one of the VantageScore credit scores, and it's very likely 3.0. So, Duke brings up a good almost topic for discussion, which is, whenever a new version of this comes out, right? My son wants it because it's the new cool version. I don't really care. I'm not all obsessed with the iPhone generations, but I get it. Every couple of years, a new one comes out. It does pretty much the same thing as the prior version, but it's got bells and whistles, and so it's a little bit better. Maybe it's got a better camera. I don't know. There's some reason why it's better that I may not fully understand. And so there are some people that are like, oh my God, I got to be at the Apple store by 10 a.m. because I got to get my new phone or whatever. So, and it's very easy to replace a phone with another phone. If you went out and bought a toaster, it's very easy to replace your toaster with another toaster. You just stop plugging in the old one, start plugging in the new one, start making toast. Super easy. It is very, very complicated and expensive to replace scoring models. In order to replace a credit scoring model at a bank like Chase or Wells or Citi, Amex, Cap, like the megas, right? The megas, the ones that have 50, 60 million active customers in the US, they have dozens of decision systems that are woven within credit scoring models, and the FICO or the Vantage score is just one little component within that model. And in order to rip out one of those models that they're probably paying a fraction of a cent for every time they buy it with another model is enormously expensive. I'll give you for any of the folks who are watching right now or who are going to watch in the future, if David, do you know what a gasket is? Like in the context of an engine of a car, do you know what a gasket? Okay, so a gasket.
Replaced a couple in my day. It's been a while, but yes.
Okay, so a gasket is used to separate or to join two pieces of metal or two components together. It's usually rubber, or in some scenarios, it's cardboard, right? And the gasket is really, really inexpensive. 79 cents. $1.29. They're very, very inexpensive, but you're going to pay $1,000 or $2,000 in labor costs to dig deep into your engine and take it apart, replace one gasket with another gasket because it was leaking, and then put all that stuff back together. Not to mention the amount of time you don't have your car because it's in there getting a gasket replaced. So the long and short of it is that you have to make a decision as a lender. Do I want to essentially spend $1 million or $2 million of redeveloping all these systems to replace something that's not terribly broken, that costs me less than a penny every time I buy it? And that's kind of what it is with respect to scoring systems. So yes, giving away a credit score on a credit report to a consumer through some consumer website, that's easy, right? Because no lender is making a decision about lending money or setting the terms of an account or trying to decide whether or not to lower a credit limit or to close an account from underneath an existing customer. Those are big time decisions that a lender has to make, and then they rely on a score to do so. But in order to convince a lender that they need to upgrade from, say, FICO 8 to FICO 9 or FICO 9 to FICO 10 or Vantage Score 3 to Vantage Score 4, it's a whole lot more than just saying, wait a minute, this one works a little bit better. It's almost, this car goes from 0 to 60 in 7 seconds. That car goes from 0 to 60 in 6.8 seconds. Is it better? Yes. Is it better enough for me to sell one car and buy another? Probably not. So that's kind of a very complex answer to your very simple question. But that's the reality, is that these things are so interwoven in bank systems that just to pull one out and replace it with another, it causes so much kind of collateral damage that's very, very expensive to deal with. And you can't just replace one with another without studying the impact. And that's really the problem, right? Because you're going to have a different percentage of people are going to score higher with Vantage Score 3 than are going to score higher with Vantage Score 4. And boy, if you're converting from FICO to Vantage Score, boy, man, all bets are off at that point, because your score distributions are going to be wildly different. So They have to understand those types of things before they actually go through those types of machinations. And for a company that's got dozens and dozens of custom-built scoring systems that have FICO built within them, it is enormously expensive and time-consuming, and not generally very high on the priority list. And I'll give you a good example. FHFA, right? You've heard me complain about it. You've heard me complain about FHFA on these Facebook Lives with David forever. FHFA makes the entire mortgage industry use scoring models that are over 2 decades old. So are there better models out there? There are tons of better models out there. But for some reason, they can't find the time to figure it out, which to me doesn't make a lot of sense, because 2 decades is a long time to do that type of thing. But that's where we are, and that's why we have all these dozens of different credit scoring models in commercial circulation, is because the credit bureaus aren't going to shut off VantageScore 3 if it's still got critical mass of usage. They're not going to shut off FICO 8 or FICO 2 or FICO 5 or FICO 9 or FICO 4. They're not going to shut those models off if they've got lenders out there using it and buying it to make decisions. That's horrible business. So that's why you end up with a ton of these models kind of piling up on top of each other.
As we're coming down to the end of it, John, Len has one last question here, and I think it's the answer is going to be the same to the one that Len asked a minute ago, but I'll read it here. It says, Portfolio Recovery says in their Q&A that they request that bureaus no longer report your trade line after you pay your collection, whether partial, per settlement, or in full after payment post. So the reason why I brought this one up, John, because I know that there's a couple angles you're going to want to attack this one on, and then we can wrap up with this. And once again, we got through half of one of the topics that we wanted to talk about because we got so many great questions from everybody.
We didn't even get through half, dude. I got through 1/3.
1/3, okay. A little bit less.
So if the practical method that collection agency would use in order to incent the credit bureaus to no longer report is they'd have to send them what's called an AUD, an automated universal data form. Or back when I was in the industry, we had the paper version, which was just called a UDF, a universal data form. It's the same form, just one is electronic and the other one was paper. So AUD is the electronic, UDF is the paper version of the same exact form, universal data form. You can Google it and probably find examples of universal data forms or automated universal data forms. That is the form that's used by any furnisher, not just a collection agency. That's the form that's used by a furnisher to kind of ask the credit reporting agencies to delete any sort of an account. To the extent that they're doing that, then okay, that's fine. I can tell you that in the credit industry's standards manual, which is the actual standards manual, there is multiple representations to not delete collections just because they've been paid or settled. The only scenario that they want their furnishers to delete collections is if they're wrong or they're unverifiable, right? So does it happen? Again, it's the difference between what the kind of formal policy is versus what the actual happening in the industry is. And I know that they're not the same. So does Portfolio delete after payment or settlement? I don't know. I've respectfully have never had a portfolio collection on my credit report, so I don't know what their practices are. But yes, there is a systemic method for deleting a collection, but the industry indicates that deleting it because of it being paid is not an acceptable method or an acceptable reason for deleting it. So it's kind of like a conflict of information there.
Yeah, I put that up there. I thought it was interesting because to have something so flagrant in contrast to the resource guide to say,
can I make a request? So Len, is it Len? Yeah, Len. Len, if you're still with us, is there any chance that you can take a screen capture of that and maybe send it to David? I'd love to see it, and maybe not next Wednesday, David, but whenever we reconvene, maybe we can talk about that and address it. I'd love to see actual real life examples.
Right, got it. Okay. Well, that was the fastest, 53, almost 54 minutes on the web right there. Right. Yeah, it took no time at all. Everybody, thank you so much for joining me and John today. I appreciate it. Great questions. And if you're watching this on a replay, feel free to post a question on Facebook because I can see those and swing back around. Unfortunately, on YouTube, I can't. They disappear with the live. John, thank you so much again, and we will see you next time. Take care, everyone.
Thanks, John.